Good morning, everyone. Thank you for joining us. As Emmanuel said, I'm Mustapha-Maduakor, CEO of AVCA. I want to officially welcome you to our 21st Annual AVCA Conference and VC Summit. This conference is really important because it is a gathering of entrepreneurs, investors, policymakers, all under one roof with one thing in common, either actively investing in Africa or looking to support investments in Africa. So I guess I'll start by why we brought the conference to Nigeria. It's the first time the conference has been in Nigeria since 2014. So a bit of background, we do this conference every year, and we move it to a different city in Africa every year. We do this deliberately to showcase the wonderful breadth of investment opportunities across the continent, and also to support in, I guess, bringing hidden gems to the attention of global investors. So it's been 10 years since we've been in Lagos. I'm Nigerian, so I'm very happy that we've come back to Lagos, and I think we've come at the right time. So if we look over the past 3 years and we look at our data, we had depressed deal activity in Nigeria over the past 2 years for many reasons, because of macroeconomic pressures and other geopolitical factors that affected a lot of countries in Africa, not least Nigeria. But what's very important now is the tide is turning. We've seen stability of exchange rates for quite a sustained period. We've started seeing exit activity happening in Nigeria, and we've started seeing investors that haven't invested in Nigeria start investing over the past 2 years. So the time is now for capital to start coming to Nigeria, and it's fortuitous that we are organizing a conference at this time where we're seeing sentiments change, we're seeing more hope about the investment landscape in Nigeria, and we're seeing more deal activity, and we hope to see even more. So I will stop there and give my panelists, my co-panelists, a couple of minutes to introduce themselves. So I'll start to my right, Mr. Andrew Alli.
Good morning. My name is Andrew Alli. I'm a non-executive board member of BII, British International Investments. It's the British government's owned DFI, which focuses on investing in Africa, Asia, and the Caribbean. We've been around for about 75 years, and we've got a very large portfolio. I think we're about $8 billion in total, and as at the end of 2023, we had about $700 million invested in Nigeria. We've made several investments in 2024 as well, although I can't give you a figure for that because we haven't yet released our annual report for 2024. But just to say that Nigeria is one of the larger portfolio countries of BII, and we've continued to invest through the ups and downs. We're a counter-cyclical investor, so we tend to be still investing when other people have pulled back, and we see quite a lot of opportunities to continue to invest in Nigeria. We invest across many different sectors, in particular financial services. So we've invested in quite a few funds, one or two of which are sitting at this table. We've invested in agribusiness, infrastructure, and general manufacturing as well, amongst many other things. Thank you.
Good morning. My name is Kola, Aina, and I'm founder and managing partner at Ventures Platform. At Ventures Platform, we're an early-stage Pan-African fund investing in tech and tech-enabled startups across Africa. We've been actively investing since 2016, and since that time, we've invested in over 100 companies. I think it's very fitting that this conference is in Lagos, because Lagos is, in fact, the heart of the African startup ecosystem. Has attracted the most capital since we began tracking, but also is the home of Africa's unicorns. We're delighted to be hosting this conference. We are delighted to be a portfolio company of BII, and we look forward to engaging with you over the next few days. Thank you.
Good morning. Good morning. My name is Danladi Verheijen. I'm the founder and managing partner of Verod Capital. Verod is a private equity and VC firm, so it's an investment platform. On the private equity side, we've been investing since 2008, primarily in Western Africa, invested in over 30 businesses, really focused on creating jobs and economic development. On the VC side, we've been investing since 2022. That is focused on a pan-African basis, and they've invested in about 8 different businesses. I'm also very excited about being here today. Look, the truth is, it is challenging times today, but this reminds me of when we started Verod in 2008, which is probably, on paper, could have been the worst time to start an investment firm. There's a global crisis at that point in time, but in hindsight, it was the best times. And it sort of reminds me of the phrase of Warren Rothschild, who said, buy when there's blood on the streets, even if the blood is your own. We think this is the time to buy, this is the time to invest, and prosperity will follow.
Warren Buffett, I think you meant.
Byron Rothschild.
Oh, Byron Rothschild. Okay. Good morning, everyone. Shola Lawson, managing director at AIM. We're an infrastructure investment firm. We manage $3.2 billion. We invest across the continent, and we've done probably five investments in Nigeria over the last 20 years. So very pleased to be here. We think there are opportunities, particularly in the energy space, telecommunications infrastructure, and also in the logistics space. Those are the 3 verticals that we focus on. And we're pleased to be a fund that manages capital for BII. But Nigeria has been tough, as Danladi said, over the last 5 years. And I think in any economic environment, if you lose 90% of your currency's value, or 85%, and you're a dollar investor, then you're going to have some blood on yourself and also on the streets. But looking forward, I think our view is that the cycle has bottomed, and investing is all about picking the right time to deploy capital. And we think in Nigeria, now is the right time. So we're very interested in some of the opportunities that this space has to offer. Thank you.
Thank you. Good morning, ladies and gentlemen. I think I'm the only non-Nigerian on the panel, as tends to be the case. So, Abby, I hope I get a green passport soon now. So I'm Genevieve Sangudi. I manage a Pan-African private equity firm called Alterra Capital Partners. The genesis of this firm started in 2012 as the Africa Fund for the Carlyle Group, which is one of the big global investors. We spun out, Alterra spun out of Carlyle in 2020. And so we became an independent platform, but continue to manage the $700 million Carlyle fund and now a $300 million Alterra fund, which we're very pleased to have BII as an investor in as well. So thank you all. Look, I sit on the board of AFCA as well. I think this is my last conference as vice chair, but at our last meeting when we were trying to pick the venue for the next conference, I had a pretty heated fight with my co-board members, especially the Nigerian ones, about where it's true now. I pushed very hard for Nigeria precisely because I think no matter what, no matter the ups and downs, and trust me, all of us sitting on this panel have experienced the downs, which are deep and painful. And yes, definitely, it was my blood on some of those streets. We can't give up on Nigeria, right? It's still the giant of Africa. It's still really important to showcase everything all of Nigeria's potential. So while it's been a tough investing environment, particularly for USD investors, I think it just means we've got to focus on micro and not macro. So you've got to pick the right partners, you've got to pick the right sectors, you've got to pick market leaders that can be resilient through cycles. You got to exit fast. I think one of the challenges we've seen in our industry is we haven't generated sufficient liquidity. And I think in order for more investors to come in, we've got to show and demonstrate that Africa can deliver the right level of risk-adjusted returns for global investors, because capital is fungible. And I think lastly, we've got to develop our own domestic pools of capital. I think that there are deep base of potential capital to invest in the continent, to develop the continent. South Africa probably has the most developed, call it pension industry, but I think Nigeria also, we could do a lot more work advocacy-wise in educating people about the asset class and why it makes sense as part of a portfolio for pension funds, insurance companies, asset managers, et cetera. So we hope that that's some of what we will showcase this year at the conference.
Genevieve, you talked about the institutional investors from Africa, and we saw a sharp rise last year in their investment. How do you explain this move that they made? Do they understand better what you're doing now? Or is it also maybe because they need to compensate a potential lack of interest from international investors? How do you explain this rise?
Look, it's better, but still nowhere near where it needs to be. I think AFCA has done a great job in educating, and I think, if you think about the South African pension funds, I know PIC and GEPF, they've also done a lot of roadshows actually going to different markets and just talking about their experience, those that have had longer experience of investing in alternative assets. So that has been helpful, but honestly, I think there's still a long way to go. We're seeing a lot more interest from the Kenyan pensions, for example, so we're very glad that a number of them are here, Francophone, West Africa as well. So I think what our job is, the investors on this table, is to make sure we actually deliver good returns, right? Returns raise money. And I think, the managers of pension assets, their job is to make sure that they deliver returns for the pensioners, and it's there. So I think it's about showing why diversification works. It's about showing that private equity has still outperformed public markets. I think that's been, for the pension funds we've been able to attract, that's been a compelling kind of story, right? Like if PE can outperform in real terms the public markets, then that's a good story as well. Anything to add?
Maybe one thing, I think if you look globally at allocations to alternatives, it's over 20% in developed markets. In Nigeria particularly, it's under 1%. So there's two things. One is understanding what the asset class can do to your portfolio. It's sort of long-term, it provides alpha. In the case of infrastructure, it provides inflation hedging, provides liability matching. So there's various things that are attractive for a portfolio. So it's about them understanding that, and investor education is required. And then it's about delivering returns. And I think, as Genevieve pointed out, it's not, it's black and white in terms of what you've delivered. And I think there's some improvement from the industry to go on that front. So, yeah.
Let me just add one more thing. It's also increasing the amount of capital they can invest in equities. So if you look at the capital markets right now, you've got liquidity in South Africa, Egypt, Nigeria, but they're not really as many companies for these guys to invest in, right? You're looking at hundreds of companies at most. By investing in private equity, you've got access to tens of thousands of companies across the continent. So I think that's also attractive to them.
Final point to add. I will say that we've been doing a lot of work, as Genevieve mentioned, with pension funds across the continent. And we split them into two buckets. So South Africa, obviously the South African pension funds, they're very versed in allocating. That's the one country you get more than a handful of funds that are fully funded by pension funds. But Ghana is also an interesting market. So we are running a program right now, funded by BII, thank you, called the Knowledge Exchange Initiative, that is basically supporting Ghanaian corporate trustees to really understand the asset class, understand the risk and rewards associated with the asset class, and then to pair them with more established allocators to guide their journey. So there is a level of hand-holding that has to be done. And I think on the other side, there's also a level of retrofitting. So we've seen some GPs that have actually changed their structures and their models to be structures that the pension funds are more comfortable with. We know that they like liquidity. So we've seen in Nigeria, we've seen some infrastructure debt funds that have worked well, the pension funds have allocated to. We know that some of them don't like blind pool investing. So I think we're getting to the stage where I think GPs are listening to the pension funds a little bit more and trying to potentially, if they can, change their structures to make them feel a little bit more comfortable. Because fundamentally, as I think it was Genevieve that said, they have a fiduciary duty to their pensioners. So although it is an asset diversification play, we understand the caution with which they approach allocating.
Perspective from the VC side of things. I think in 2020, 2021, we saw a rise in participation by HNIs and local family offices in Nigeria. But with the FX swings that we saw very recently, what we've seen is a pullback of local participants in venture funding. And I think our message is you have to invest in every vintage, because just because you've had a market cycle go the other way doesn't mean you pull back, because you miss out on the best companies in those vintages. And so we're hopeful that as stability has returned in Nigeria, we hopefully see a return in the early stage segments by HNIs and family offices.
Just to add a final couple of points. I mean, BII has been sort of part of the development of the private equity industry in Africa from its more or less inception in the early 2000s till today. What we call mobilization, which is bringing other investors in apart from us, is something that's very important for us across all the sort of asset classes we invest in, including private equity and VC. And so I think that we have been very kind of conscious to try and work with other investors who are maybe not so familiar with the African markets to give them comfort. And also we sort of bring in the sort of governance, that ESG, etc., that is also important for many of these investors. But at the end of the day, I think most of the credit would obviously have to go to the fund managers who are delivering the returns, because if you can't deliver the returns, then you don't really have an industry to start off with. The final point, which I think Abby talked about a little bit, is around the structures. So the African institutional investors do look at things differently from the more global ones, and having sort of structures whereby you can address some of their concerns which are different, particularly around sort of liquidity. Many of them don't like to sort of have their funds tied up for 10, 12, 14 years without being able to get any liquidity. So I've seen some structures where people come in to sort of essentially provide some degree of liquidity to those institutional investors. They also don't like the blind pool concept, i.e. we're just going to give you money and we don't know where that money is going to end up. So again, structures where they have a bit more visibility into where their money will end up, I think would also continue to attract them. Thank you.
Hi, good morning. My name is Alexander Onukwe. I'm a journalist at Semaphore. My question is around infrastructure investment. I wonder to what extent does AFCA have sort of like a mandate to nudge members towards that? And what's the general perspective from commercial investors in investing in African infrastructure, given, depending on who you ask, it's like $100 billion a year that you need to invest in African infrastructure. But I imagine it's not as maybe convenient as investing in fintech or some commercially beneficial thing. So how does AFCA approach the continent's investment gap, and do you nudge members towards that sector? Thank you.
Please, AVCA Board Director.
I'll start and Abby can finish. Let me take your second question first. So try to invest in commercially interesting things. So we're not a public benefit corporation. We think infrastructure is an exciting space. I think globally it is right now one of the most attractive investment subsectors, and that's That's for a number of reasons. I think you're right from the perspective of the classic understanding of infrastructure as an asset where your counterparty is government. You have a long-term concession. Those models have not worked in Africa by and large. They have not worked in Nigeria. And that's because, I guess over the last, particularly after COVID, what you've seen is weakening government balance sheets, utilities unable to make payments when due, value chains, particularly in the energy sector, challenged. So what we've done and what has resonated with investors is we've said, okay, look, let's find pockets of the infrastructure landscape which have a number of characteristics. One is that they are growing irrespective of what's happening with GDP. So there's an underlying secular demand tailwind. I'll give you an example. Data consumption on mobile phones. You know, just when people switch from old school phones to smartphones, your data consumption goes up 7 times. It doesn't matter if the economy is growing at -3 or +4. It's a secular trend that continues happening. So data demand is growing. That's one theme. The shift to clean energy is another theme that's just an unstoppable force. And then the third is around urbanization. More people are moving from the rural areas to the cities, and therefore, how can you build infrastructure to move people and goods? So if you focus on those, on specific themes, if you pick counterparties, which are private sector counterparties, as opposed to government counterparties, but high credit quality. So telecommunications, you look at the tower companies, counterparties are mobile network operators. In the energy space, you provide energy directly to commercial and industrial customers as opposed to government. And in the logistics space, you focus on ports where your customers are international clients. Those models work, they're commercially attractive, and they've been able to attract investment. Now, in terms of what AFCA is doing, we very recently published a report, it was last month, which was very well received. There's a separate sustainability forum, which holds annually, which looks to attract investors into the African climate infrastructure opportunity landscape. And you know, they put people like me on the board, so I hope that helps.
Thank you.
Okay, thank you. My name is Mele and I write for Bloomberg. I want to ask, how has Donald Trump's trade policies and even the stoppage of US AID actually impacted your strategy in Africa? Or reshaped your strategy anyway in Africa? Something must have given way.
Well, look, I think the uncertainty certainly doesn't help. The startup ecosystem certainly benefited from the participation of U.S. investors that helped catalyze valuations, or in some cases, overheat valuations here in Africa. And so we've definitely seen a sort of slowdown as people try to figure out what the government's direction of travel is. In terms of USAID, I think a decent part of the earlier stage incubation and acceleration and activity was actually partly supported by USAID funding. And unfortunately, I know I can count a couple of programs that had to pause, stop work effectively as an outcome of that. But I think it also speaks to the need for us to look inwards as a continent. I mean, we can't perpetually rely on the benevolence of the US or the partners. I think the conversation has to shift to trade and investment. And I think that's something that, Nigeria, I've heard the Minister of Trade and Investment really focus on, particularly in light of the AFCTA. There's so much more that we can do within the continent amongst ourselves as countries. And so I actually would like to focus on the silver lining that this presents. Thanks.
I guess if I could just add to that, I couldn't agree more in terms of the uncertainty, and certainly for now, less capital coming from the U.S. development, the DFI. But yeah, I think it's also an opportunity, right? I think the shift is not just necessarily going to be with the U.S. in the long term. I think we're seeing even sort of, European development finance institutions reducing some of their allocations just from a budgetary perspective and spending more on domestic, whether it's defense, et cetera. So I think we as Africans, I think there are things we can always learn, never let a good crisis go to waste. During COVID, we saw the limitations of just not having our own supply chains, right, on pretty basic stuff. And so hopefully this crisis also leads us to focus on trade, focus on more sort of domestic production. And then I think from a private equity perspective, if I look, across our portfolio, I don't want us to overstate the immediate impact, right? Because we're investing in a diverse range of assets. So one interesting trend that we've seen, we just invested in a tourism asset in East Africa. So what we've seen, let's looking at global tourism reports, tourism to the U.S. just declining sharply, right? So that people just boycotting U.S. travel. And we're sort of seeing that that's giving us quite a positive bump. So can see out for the next 12 months and how bookings have just accelerated pretty dramatically. So I think once again, it's micro. Yes, we have to be cognizant of all of the big sort of, issues that are happening globally. But I think our job as fund managers is to say, even within the most chaotic and most uncertain times, can you find that pocket of opportunity, even in difficult times? So even over the last 5 years or 4 years in Nigeria, even with the FX deval, I'm sure my brother Danladi has still made good money on some deals that have, continued to perform in dollar terms despite that.
Yeah, if I may just add to that, I think my colleagues have said the key word is uncertainty, right? And just speaking on a micro level, just give one other example. We've got one company that exports apparel to the U.S. So initially, the increase in tariffs were concerning, but then you've got to look at that relative to how much tariffs went up by in other countries that also export apparel to the U.S., and it went up much higher. So for our portfolio company, it was actually a good thing. And then there was a 90-day pause on the tariffs to the other countries, and then now we're uncertain again. So we're not quite sure how that will play out. And I think it's like that just sort of across the board. But I think the one area that may give me some or the most concern actually is the price of oil dropping significantly and what that means for the fiscal status of the country. And if that happens, the implications on growth here, right? So not quite sure where that will go. But also, as Genevieve said, I mean, our job is to look at hundreds of businesses and pick a handful that will outperform the economy, right? And I think that's what we all do here. And so from that perspective, I still think the long term for the asset class is very positive.
I'll just add maybe one thing from an investor perspective. I think what you're seeing with this move from a sort of unipolar world to a multipolar world is that there are other pockets of interest in Africa that are emerging, and particularly two. I think the Middle East, if you look at the numbers over the last 2 to 3 years, have been one of the more significant investors in the African infrastructure space, and I think probably applies a bit wider as well. That wasn't the case 10, 15 years ago, and then obviously China is deepening its interest in securing positions. I think that may extend to other nations in Asia. So, as one door closes, multiple other doors could potentially open.
Just going to add one final point. So from an ecosystem perspective, when we look at, in terms of capital allocation, historically, actually, European allocators commanded the largest share of allocation to private capital funds. So it wasn't actually the US. But having said that, obviously that pool of capital is going to die, but it wasn't as much as the European or the African. So I think that's the first thing to note. Another thing is when we look at the LP profile 3 years ago, so the allocators to private capital funds 3 years ago, versus when we looked at it last year, the pendulum has swung a little bit. So before it was, I think 20%, maybe my research team will correct me, 20% African institutional investors, 80% global. Now it's 40% African institutional investors. So to layer on Kola's point, it's definitely an opportunity to link it back to the local capital mobilization. It's an opportunity for local pools of capital to step in and kind of replace this capital gap. And I think more practically, it's a call to action in Nigeria. So my personal worry is obviously some of the businesses that are affected by this, there's no longer a goer. We're a net importer in Nigeria. So a lot of, for manufacturing businesses, a lot of their raw materials and, inputs, they're imported. And with these tariffs, these costs are going to go up. So the ultimate cost to the consumer might increase. So it's more of a call to action for us from a trade policy perspective to think about how to further integrate backward integration in Nigeria and to use policies to be able to improve the domestic manufacturing and reduce the reliance on imports. So, like fellow panelists have said, every challenge is an opportunity, or whichever way you put it.
So my question is, considering Africa Invest's early bet on InstaDeep and their exit, are you thinking or looking for your biggest winner in AI? Also, beside the big corporations like Cassava and the big tech like Google, Microsoft, is the private equity sector and the venture capital sector on the continent looking to invest in AI? Because we haven't really seen like much investment in the local AI company. And I'm just wondering if you think there's an opportunity there for growth.
I'll take a stab at that. I can tell you for sure that the venture capital funds in Nigeria and across the continent are definitely awake to the AI opportunity. Not only are we actively looking to invest in AI companies, we're also seeing fund managers adopt AI technologies to improve their efficiency from sourcing to diligence, and various parts of the VC sort of workflow. I think a consensus is building around this belief that every company is effectively an AI company. At the minimum, to compete, you have to be AI enabled, and so we're all actively working with our portfolio companies to ensure that they're developing AI capabilities to better serve their customers and improve efficiency. But then you have this segment as well of companies that we call AI core companies that are basically building AI first technologies, not at the infrastructure level, but at the service level. We're seeing innovations that are helping to improve the efficiency of call centers. We're seeing innovations around helping FMCGs make decisions about distribution smarter and more effectively. And then, of course, the final bucket where I think we all have to be pragmatic about our competitive advantage is what you call the AI core companies, the infrastructure layer AI type of companies. And I think it's important to note some of the work that's happening across various countries. Nigeria, for instance, has launched an ambitious program called 3MTT that has a particular AI and machine learning segment that's looking to sort of churn out talent since we have a large youthful population. I know there are programs in Tunisia and Egypt. And so, look, I think in the coming years, I wouldn't be surprised if we have one or two more InstaDeep type of outcomes in the AI segment across Africa. Thanks.
Let me just add to that. So if you sort of look at AI and then look at what goes into it, there's going to be a huge need. I mean, just to back up, so AI is still quite nascent, and I would sort of liken it maybe to where the internet was in 1995. So, there's a newish technology we recognize is going to be big, but, people are really just getting started. But one thing that people often don't quite realize with AI is just the huge requirements for computing power and data. And therefore, the trend that Shola mentioned around sort of data centers, data processing, the infrastructure, the sort of telecommunications to actually move all this data around, the power that goes into these data centers, all these require massive investments and a lot of infrastructure. And I think that those are also things that both DFIs like BII and at least some of the funds that are in AFCA, around infrastructure and technology can and should support. I think the other thing that AI brings is actually a very strong requirement around this sort of ESG, because again, the data centers require large amounts of energy. They also use quite a lot of water for cooling, particularly the AI-related ones. So, the impact of these things on the environment is also can be very significant. And therefore, thinking about how to do these in more climate-friendly ways and using technology, renewable technology, for example, to power them, I think is also important and also presents an opportunity for investors in Africa. Thank you.
Just one point to add to that. I think from an infrastructure perspective, where there's a big opportunity for certain countries in Africa in the AI space is building large-scale training-focused AI data centers. If you think about what you need for a data center, you need cheap land, you need cheap power, you need connectivity, and those things are becoming increasingly scarce in certain parts of the US and also in Europe. Training infrastructure where they're just training the models don't require a significant amounts of latency, so you don't need to be close to the end consumer. And that, therefore, is potentially able to create an opportunity for certain African countries. Why can't you build large-scale data center infrastructure? So, for example, we've got a company in Morocco, which is a leading data center company, and we're looking into seeing if we can address some of the training needs of the hyperscale operators that would be building stuff in Europe, but actually they can't find land, or the permitting requirements are too complex, or power is too scarce. Whereas in Morocco, you have all these things in abundance. So that could be an opportunity for us going forward.
Hi, everyone. Good morning. So my question is more about return and exits. I know currently a lot of VCs and PEs, a lot of VCs and PEs rely on secondaries or selling shares to other investors for that exits. That's been the predominant way to get exits for like the past 2-3 years. How do you as investors think about that on both the seller side and the buyer side? How do you weigh how much you buy like shares in a startup, for example? If I have shares I want to sell to you as an investor, how do you price it? How does that work basically from both the buyer side and the seller side? And this loop of investors selling to investors, do you think it's something that's sustainable for the long run? Thank you.
That's the question we all hoped you didn't ask, because I think our nightmares are filled with the phrase, "Where are the exits?" Look, I think there's no gainsaying that Africa we all have a lot of work to do in deepening the liquidity space. We have seen some exits, but they've been primarily strategic acquisitions or secondary exits. And in our case, as early stage investors, we've done quite a number of those secondary exit type transactions. It's not unique to Africa. Across the world, you have secondary funds that are dedicated to buying secondaries of companies that are largely de-risked. And I don't know that I'll be particularly alarmed that people are doing exits. I think the challenge that I would keep an eye on is, if the sort of terminal exit scenario of strategics or IPOs doesn't sort of open up in, I don't know, 5 to 7 years down the road, I think then you have a bit of congestion at some point. And so I think we all have to keep an eye on it. But I think the secondaries are important for the recycling of capital. They definitely help us show DPI to our own investors as early stage investors. It's a little harder for the later stage folks, which is why I'm not on that side of the table. But for us, it's definitely welcome. In terms of how we think about how much we sell and how much we keep, I think the danger in focusing too much on early liquidity is that you miss out, you can potentially miss out on your winners. And so I think every fund manager would tend to develop in-house sort of rubric. For us, we are conviction-based investors, so we typically would be looking to buy anywhere between 10% early, and increase our ownership as we go. And that then presents us an opportunity to do a partial that allows us sort of have the liquidity, but allows us benefit from the future upside that we're all hoping for, the unicorn upside potentially. So look, I think that would be the general approach that fund managers would take, but it would differ from fund to fund. Yeah.
So if I may, from the private equity side of things, I actually love the question. My friends at BAI can attest to this because I like talking about the fact that in the last 2 years, we've had 8 full exits, returned over $600 million of capital back to LPs. And most of the exits were to global strategic players, everyone from Saudi Telecom, Morel and Prom, Moody's, et cetera. And I would say, just looking back, the lesson there is not every good company is a good private equity investment. And there is a massive difference in that. You can have a great company, but if there's no viable path to an exit, maybe it should just remain a family-owned business. And there are places, obviously, in the ecosystem for companies like that. So as we get, and then private equity is a repeat business, right? As you do and do and do over again, you see what works, you see what didn't work. And I think the big thing there, part of the challenge we've had in the private equity industry is just there's a lot of zombie assets, right? So there's just a lot of assets that have just sat on the books of private equity firms for too long. And then I think it's just the discipline of just knowing this is not going to be a 2x or a 3x deal, right? After 10 years. And sometimes it's better you got to do the best for your LPs, but sometimes it's also knowing when you need to deliver that exit and return and deliver the liquidity rather than holding on just for hope value. But I think lesson when you're buying a company, you start with thinking about the way out, right? And being disciplined about the hold horizon. Exits also take much longer than anticipated. So an average exit process, I don't know you guys' experience, I'm finding it's 18 months, just from when you start. And so I think just being very rigid about that. Also buying businesses that generate cash, right? You can't also bank everything till that final exit point because you may not get the window just right. Things out of your control from a macro perspective happen. So in between, we really like to build in discipline of businesses that pay dividends during our holding period. It helps with IRR, et cetera. But so I do think, once again, just like you can look at the whole landscape and say, well, zero growth, industry hasn't delivered exits. I think investors also have to pick the right firm to back. So not every firm is the same. So I do think, there are firms that have been good at delivering exits consistently. Like Alterra. I do say so myself.
Just marketing.
I couldn't help.
If I can just add, as Genevieve just mentioned, there are quite a number of zombie assets floating around, and I think that sort of earlier iterations of funds or investments by funds may not have focused too much on the exit, and really as you're making the investment, you should actually have an exit plan almost at the moment you make that investment. But I think that does speak to the fact that there probably is a market for secondary funds who can sort of buy these assets, give a bit more time and a bit more focused on exiting them. I think the other thing that needs to happen more, but that's much more of a longer term discussion, is really how our own capital markets can be enhanced to actually allow for more local exits. Because the fact is that today, if you're more than a certain size, you in order to get both the valuation and the liquidity, you essentially need to exit in a Western market if you're going to list. And if you get above a certain size, actually doing strategic exits becomes more difficult. And that's actually why some of the more successful companies from a business perspective have maybe struggled to get exits. So there is more work that needs to be done by various players in the sector, but I think smart fund managers can still find exits, as Genevieve has pointed out to us.
I think from our perspective, I think the only way is up in Nigeria, and I think that's it's always a good time to come in when there's a clear trajectory in terms of the environment. And from the rest of the continent, I think we're excited about the themes that we invest behind. We're excited that those subsectors will continue to grow, and there's opportunity to build market-leading companies in those subsectors. So, yeah, thank you.
Resilience.
Hard work, but good times ahead.
I think BII, we're always here, basically. Thanks.
I'll say we're excited to invest in Nigeria across Africa. At this time, Africa presents the most compelling opportunity for market creation. I think if you're not investing here, you're missing out.
And I'll close with cautious optimism and hope.
Thank you. Thank you, everybody.